Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report so exciting it's like waiting for your tax refund you hope you get money back. We're looking at Miller Investment Trust's shareholder report, and trust me, there's more than meets the eye. It has funds within funds like a financial turdu chicken. We'll check out how their convertible bonds are doing, what's up with intermediate bonds, and if their market neutral income strategy is actually keeping things steady. It's a lot, but we'll break it down in simple terms, I promise. Before we get started, if you like understanding what's really going on with these big companies, make sure you subscribe. Join our Discord community through the link in the description below for more insights and discussions. First off, there was a refiling to update information, specifically to include a broad-based index in their total shareholder returns, also known as TSRs. They wanted to give investors a better comparison point and included some extra information. Let's start with the Miller Convertible Bond Fund. These funds invest in bonds that can be converted into stocks, offering a mix of safety and potential growth. If you had $10,000 invested in Class A shares, the cost for the last year would be around 151% of your investment with them. Here's how a $10,000 investment would have grown over the last 10 years, comparing it to some benchmarks. Notice how much the value of the ICE Buffer All Convertibles Exclude Mandatory All Qualities Index increased, compared to the Bloomberg US Aggregate Bond Index. It shows how convertibles can rise more than bonds in a good market. Let's see how the average annual total returns shake out. In the past year, the Miller Convertible Bond Fund without the load grew by 12.64%. Over 5 years, it was 4.73%, and over 10 years, it performed the fund there, but its 5-year return was actually negative. The ICE Buffer All Convertibles Exclude Mandatory All Qualities Index has consistently done very well over all time periods, topping 20% in the past year, but only 1.49% over the past 10 years, so it outperformed the fund there. But its 5-year return was actually negative. The ICE Buffer All Convertibles Exclude Mandatory All Qualities Index has consistently done very well over all time periods, topping 20% in the past year. Some quick stats. The fund has almost $670 million in net assets and 78 holdings. They paid around $5 million in advisory fees, and their portfolio turnover was 73%. This means they changed a good portion of their investments over the year. In terms of what they invest in, convertible bonds make up 98% of their total investments. The other 2% is in money market funds. What about the sector weighting? A big chunk, 28.2%, is in technology, followed by industrials at 20% and healthcare at 17.2%. These are the areas where they see the most potential. What are their biggest bets? Amazon tops the list at 3.6%, followed by Alphabet and Microsoft near 2.8%. This shows they're leaning into big tech with these synthetic convertible bond positions. Here's something important. No material changes occurred during the year ended October 31, 2024, so the fund stayed pretty consistent in its approach. Now, let's check out the Class C shares of the Convertible Bond Fund. They mirror the first fund but charge different fees. As a reminder, costs matter for Class C shares with a $10,000 investment. The cost paid as a percentage is 2.02%, amounting to 2014, so these shares have a higher expense ratio than the Class A shares mentioned earlier. Let's check out what makes Class I so different. It's all about lower costs, which can boost your returns. With a $10,000 investment, the expenses are only $109 or 1.02% of the investment value. It's clear to see that Class I offers the lowest costs. Alright, let's switch gears to the Miller Intermediate Bond Fund. This one's focused on bonds with a maturity between 3 and 10 years, aiming for a balance between income and capital growth. It's also worth noting it's a much smaller fund compared to the Convertible Bond Fund, only having $206 million in net assets. In the past year, this fund grew by 14.0 to 10.45% for the Bloomberg US Aggregate Bond Index, but its past 5-year growth is more modest. Looking at what they hold, convertible bonds make up almost 93% and corporate bonds 6%, with the rest in money market funds. What are its largest holdings? Everest Group makes up 2.5% and Microsoft again near 2.5%. These are also top holding of the previous fund. Like the Convertible Bond Fund, there were no material changes this year, so it has been consistently sticking to its investment plan. Now let's move on to the last fund on this report, the Miller Market Neutral Income Fund. It sounds complicated, but we will simplify it. As of 2024, the cost on a 10k investment comes out to 140.44. Dice noted that the fund was not in operation for the whole year, so the cost would normally be higher. The fund had an average annual total return of 7.98% in its first year, better than the Bloomberg 1-3-year US government credit index, which was 3.78%. Some high-level numbers here. Net assets stands at $37.5 million, and it also has 72 holdings. Looking at the sector weighting, the fund leans heavily into healthcare at 33% and technology at nearly 30%. Its short positions help it become market neutral, which hopefully provides protection in a downturn. Their biggest investments included Microchip Technology, SoFi Technologies, and Guaiwire Software. And just like the others, no material changes occurred during the year, sticking to its core strategy. So what does all this mean? Well, each fund has its own risk and reward. The convertible bond fund has grown steadily over the last decade, but its performance has trailed its benchmarks recently. That wraps up our analysis of Miller Investment Trust's report. We covered the funds, the investment strategy, the finances, and what it all means. What do you think? Do you agree with their investment strategy, and how do you see these funds performing in the future? I am not an investment advisor, so this is not investment advice. Drop your predictions in the comments. If you found this breakdown helpful, be sure to like and subscribe for more content and join our Discord community. See you in the next video.